Okay, everybody, welcome back again to another Discovering Multifamily Investor Association meetup. Appreciate everybody taking the time out at 6 o'clock Eastern time. Adam is not exactly on Eastern time, but we also appreciate the time he's taking out to be with us here today and talk to us about a pretty interesting topic. I think everybody might be able to relate to or will at some point. So really appreciate his time, and thanks again for coming on. And looking forward to hearing this presentation. And, we generally have we've been doing weekly meetups with the guest speaker and presentation. We'll see how much it's going to happen in the future in terms of weekly, bi-weekly, but this will continue to happen because it's been pretty useful, at least for me and some other people on here. So with that being said, Adam's going to talk to us about how to use creative ways such as life insurance to invest in other asset classes such as real estate. So Adam, I'll give you the floor. I think I gave you spotlight so everybody can see Adam, and we'll get going. I'll let you take the floor.
Well, thank you, Anthony, for the opportunity to just share with your community and everybody who's on here right now. Thank you for carving out some time this evening to come learn maybe something new or something you've heard of and get some more info on it. I promise you tonight you'll walk away with some very impactful information. The strategy I'm going to share is one I've been doing with my own money since 2011, investing in real estate. It's not necessarily for everyone, but at the same time, I think for those who think, oh, this is a good strategy for me, it can make a big impact on the end result as far as building wealth. So I'll get more into that, but just real quick background on me. We won't spend a lot of time on it, but I want to give you guys an idea of why I might be worth listening to and have something worth sharing. My full-time job is I work at Prevail Innovative Wealth Strategies in Kansas City. And my specialty is working with real estate investors on capital strategy. So this thing we're going to talk about tonight. And really it comes down to how can we put you in a position of most control where you have liquidity and access to your money when you need it to do a deal, but also insulate you from rising tax rates, insulate you from market risk, creditors' judgments, lawsuits, those types of things, and also create a tax-free legacy for your family at the end. And that's really what my full-time job is helping real estate investors design those types of strategies. Prior to being in wealth advising, I was a street cop for a little over 15 years. I got into real estate investing in 2011, starting with wholesaling and doing single family rentals. And then after building a small single family portfolio, sold that portfolio off. And in 2019, got into multifamily, where I am a limited partner in a 52 unit deal here in Kansas City. And I'm looking to be a limited partner in more deals. So from a networking standpoint, guys, after tonight's talk is over, definitely would love to connect with anybody, always looking to build my network with other real estate investors. And tonight, I just want to share with you guys, again, a strategy that has really changed the trajectory of my finances and has been very impactful in my world, and it could be in yours. So we'll talk about it. I think my presentation tonight will probably take us between 20 and 30 minutes. And then maybe we open the floor for some questions. I think Anthony is going to be watching the chat. So if somebody has something and we're able to get to it in the middle, we will. Otherwise, we'll definitely make sure we get questions addressed here at the end. I'm going to switch over to screen share now and jump into capital strategy for real estate. Little low volume wise. I don't know, Anthony, how do I sound to you? Am I a little too quiet?
A little bit, maybe. I don't know where your microphone is.
Maybe lean up closer here.
That's better.
And I can try to make it a point to talk louder too, guys. One thing it's telling me, Anthony, I'm trying to share my screen. Are you able to make me host? Okay.
Yep.
Let's try again here. Hey, now it's going to let me. Perfect. All right. Can you guys see where it says capital strategy for the real estate investor, and ignore the date on there? That's the last time I shared this.
Yep.
All right. So just to open up, I like to ask questions that get us to think. So first question being why? Why are we even in real estate? Why are we even doing this thing of multifamily real estate? And I think ultimately what it comes down to is freedom, right? And of course, the obvious answer is financial freedom. But I think beyond that, assuming we achieve financial freedom through this tool of income producing real estate, what's it really about? And I think what it really is about for most of us is that time freedom, right? Being able to do what we want, when we want, where we want, with who we want. And so with that in mind, kind of to guide the philosophy as far as wealth building is concerned, let's kind of start looking into what it is we might already be doing as far as a capital strategy, and then could we make it better? So I think what makes us unique at Prevail as a disruptive financial firm and wealth planning firm is we like to look for blind spots. It's not so important, I don't think, about what you already know. I think what's really important is the things you maybe haven't considered or the questions you maybe haven't asked yourself. And by asking questions that open up blind spots in our strategy, whether that's in your real estate investing, in your other family's investments, or any other type of strategy, I think opening up blind spots is where the value is, because it's not what you know that's going to be a problem. It's what you don't know or that you missed. And so let me just ask you guys 3 thought-provoking questions when we think about your capital strategy for real estate. First question, is your capital or your cash that you're using to do real estate deals, is it protected against market risk? And are you insulated from rising tax rates? Second, what is the cost of interrupting the growth of your capital account? So if you're warehousing cash somewhere, whether that's a brokerage account, money market, savings, checking, otherwise, every time you pull money out of that account, I'm going to assume it is an interest-bearing account that earns you a little bit of an interest. What's the cost every time you draw money of interrupting the growth of compounding? And then third, is your personal wealth completely concentrated within your business? So if your business is multifamily real estate investing, or any business for that matter, is your personal wealth concentrated in that one place? And the reason that's important, again, a blind spot is if something that we don't anticipate occurs in the business, and I'll give you an example. Let's say your business is you have a 100-unit property, and we have something occur like happened in March, where we have a quarantine and all of a sudden the majority of our tenants are struggling to come up with rent. Is all of our wealth concentrated in that one place? If so, it can be a blind spot. So in response to these 3 questions I asked them intentionally because we're going to address all 3 of them tonight. I'm going to show you a capital strategy that will allow you to insulate your capital from market risk and rising tax rates. I'm going to show you a capital strategy that allows you to enjoy uninterrupted compounding growth of your cash when you're in between deals or when you're doing deals. Uninterrupted compounding growth. And I'm going to show you a capital strategy that will allow you to maximize the use of every dollar and accelerate wealth creation by growing multiple assets simultaneously. And I'll show you how we do that here towards the end of the talk. So let's start with where we currently put cash. And you're welcome to contribute in the chat part of the screen. I don't have chat up, but Anthony can be monitoring and we can respond as the comments come in. But where do you currently put cash? Are you putting it in business checking, business savings? Are you using a money market? Are you using bonds? Are you using a brokerage account? Where do you put cash when you're in between deals? Because obviously, if you're in real estate long enough, you begin to have this good problem that all of a sudden you start accumulating cash in different places. And so the question becomes, where can I put my cash? What's the smartest place to put it? Where can I warehouse it? And so I want to look at this from a tax perspective, because if you're in America, there's really 3 places that you can put cash from a tax perspective. The first place, and we're just going to call them buckets, different buckets. So the first bucket is the taxable bucket. That's things like your savings, checking, brokerage accounts, bonds, CDs. Every dollar that's in there, we get a 1099 at the end of the year on whatever interest or income that money produced, and it's taxable. Now, there's a reason to have money in this bucket. It's highly liquid. You can move money very quickly between savings, checking, brokerage accounts. So a lot of liquidity here. But of course, from a tax standpoint, wouldn't it be nice if we could grow that money even when we're in between deals and not have to pay taxes? So let's look at the next bucket. Next bucket's tax deferred. This is all your traditional retirement accounts. So If I make $100,000 this year and I put $10,000 into this bucket, I'm only going to have to pay taxes this year on earning 90,000 instead of the full 100. Of course, the flip side to that is when we get to the distribution point where we're taking money out of these accounts, then we're paying taxes on all of it, not just what we put in, but also any compounding gains that we would have earned. And here's what's interesting. I find that it doesn't matter if they're making a lot of money or not that much money or somewhere in between. All of the clients I meet with, it seems pretty consistent. The ratio is that between taxable, tax deferred, and then tax free, which we're going to talk about in a second, I find that 80% or more of everyone's wealth seems to be concentrated in these first two buckets. In other words, 80% or more of everything you've accumulated, you're currently paying taxes on today, or you're going to be paying taxes on tomorrow. And there's a third bucket, and I feel like we don't talk about it enough. It certainly doesn't get brought up in traditional financial planning conversations that much. If so, it's like a thought in passing. And if you read the popular media or even like Wall Street Journal, Forbes, Inc., Entrepreneur, they don't spend a lot of time talking about tax-free options. And it's very interesting to me. Why wouldn't we be more interested in tax-free options? Specifically, when you look at the amount of spending our government's doing right now, and I don't want to go on a rant, but I mean, where do you guys think that tax rates are going to go in the future? Do you see income tax rates going down in the future, or do you see them going up? Because usually when I ask that question, the answer I get pretty overwhelmingly is, well, I think tax rates are bound to go up. And I would tell you guys, I agree with that statement. I believe that's the case. I also believe it's a really popular conversation in politics right now. And Anthony, I see people are chiming in on chat. Has anybody kind of offered their thoughts on that?
We got one up. I say depends, but potentially up, and then go with stay the same. So we got a varied response.
Yep. So, and we can go with the other two scenarios too. Let's just say that it depends or they stay the same. Would you rather pay taxes on the money as you grow it, or would you rather be able to take money and use it tax-free? And I think that we'd always prefer to not have to pay taxes if we don't have to. So here's our options when it comes to tax-free. First off, Roth IRA. Probably the one that comes to mind most frequently, and there's some great advantages with the Roth IRA. You can, once we earn the money this year and we pay taxes on it this year at today's known tax rates, we can put it in a Roth IRA. We can grow that money tax-free. Doesn't matter how, if you turn $100 into $1 million, doesn't matter. You grow it tax-free. And then you can take it out in retirement as tax-free income. And then of course, it being a retirement account, it has some built-in asset protections. Unfortunately, there are some downsides. There is a trade-off, and that is that in order to make money in a Roth IRA grow, you have to subject it to some risk. You have to invest it in something. The IRA itself is not an investment. It's just a vehicle. It's just a place to put the cash. You got to do something with it and take some risk. Second thing is you can actually make too much money to contribute to a Roth. And that's the problem for a lot of the clients that I work for and a lot of the successful real estate investors I work for, is they end up making too much money that they're not even able to do a Roth. There's also contribution limits. You're capped at $6,000 a year. Unless you're age 50 or older, you can do $7,000 a year. Well, if you're making, $150,000 a year, being able to put $6,000 into this bucket is a helpful start. But I mean, that's not even 10% of your income. So how do we get more money into a tax-free environment? And then of course you have withdrawal restrictions on your gains. So any money that you would earn as a gain within a Roth, you can't take it out till you're 59 and a half without penalties. And then obviously there's IRS reporting. They know about every dollar that you put into this. So those are just kind of the recognizing both the good and the bad. And there's a reason to do these. Obviously, a lot of folks have them. I've got a Roth. I recommend you do it if you can. Why wouldn't you get your money where you can grow it tax-free and take it out tax-free? But there's limitations. So there's another option that often is not discussed, and that's what we're going to spend the balance of our time on tonight. And that option is permanent cash value life insurance. And the reason it might be worth looking at, and again, not for everybody, but the reason it might be worth exploring and looking at is you get all the same benefits that you get from a Roth. You can grow the money technically tax deferred, but I'm going to show you how you can do it tax-free. And you can take income tax-free in retirement, and you still have a lot of built-in asset protections. And on top of that, you can actually, the account's productive from day one. So You don't even have to subject the money within a policy to any risk. You have contractually guaranteed upside from day one. There are no income limits, so you can earn as much money as you want to earn and still contribute to one of these. You don't have any contribution limits. You're not capped out at $6,000 a year like with a Roth. There are no restrictions on when or how you withdraw. You can access your money anytime. And there is no IRS reporting on this. It's a totally private off the balance sheet asset. And as a bonus, you can achieve uninterrupted compounding growth within a properly structured life insurance policy. And we're going to talk about that here on the next slide. So obviously very interesting. All the benefits of the Roth, none of the drawbacks. So how does this look and how does this work? Because I think this particular asset, and we're going to talk about it from the terms or the standpoint of it being an asset, this particular asset class, when it's structured properly, has some tremendous tax advantages. However, I think when you hear stories or negative sentiment towards life insurance as an asset class, it's usually because it wasn't structured properly. And so we're going to talk about that for a second. So there's actually a minimum and a maximum amount you can pay for a given amount of life insurance death benefit. That's interesting. Think about that for a second. Normally, if somebody's interested in purchasing life insurance, they're thinking about the death benefit. And so let's just use a round number of $1 million death benefit. You would go into the insurance shop, have that conversation with the agent, come to the agreement, okay, yeah, I need $1 million of death benefit coverage to replace income, pay off debts, whatever it's for. I want to get the lowest price that I can for that $1 million of coverage, obviously, because it's a line item expense in my budget. So the lower I can keep that expense, the better off I am and still get that $1 million death benefit protection. Did you know, though, for that same $1 million, if you're purchasing a whole life insurance policy, a cash value life insurance policy, there's actually a maximum amount you can pay in premiums on that policy. The IRS actually sets that limit. And why would the IRS have any interest in capping the amount of dollars that you could pay for life insurance? And it's quite simple. The reason is when you structure it properly, it becomes very much like a Roth IRA where it is a tax-free account. You have liquidity, you have access to the cash, and it's off the IRS radar. So that's why they have an interest in, governing the maximum amount you could put into one of these. That limit is called a MEC limit, modified endowment contract. And here's the difference between a life insurance contract that would be structured in the traditional sense, like when you're just going in to buy a death benefit, versus the way we do it where I work at Prevail, which is we're trying to build a tax-free asset. So here's what a traditional policy looks like. We try to purchase the most death benefit for the least amount of dollars. And therefore, we accumulate a cash value that is very small, insignificant, never even approaches that MEC limit. And when you hear Dave Ramsey, Susie Orman, or whoever else, saying bad things about whole life insurance, it's because they're having the understanding of this traditional model. But what we do is we flip that model on its head and we say, I want to actually purchase the least amount of death benefit. And I want to put the most amount of dollars in this thing so that I can get some good accumulation and some good growth and have this tax-free cash account or capital account that I can then leverage into other things I'm going to be doing, like real estate or buying businesses or what you name it, whatever it is, private lending. It could be anything you want to use it for. So we structure it in a completely different way, and it creates a completely different outcome. And I'm going to illustrate that with an actual client case study here in just a second. But just want that everybody to get that key understanding on there's a right way and a wrong way to structure a whole life insurance policy. And so we're going to talk about doing it the right way. So before I get any further into that or do a client case study, and before, we just bite off on this idea that, okay, this guy who is an insurance professional, because I'm an insurance professional. I make money doing this for people. So let's not take my opinion. Let's look at some examples outside of what I'm telling you tonight. Let's look at the research I did personally before my family and I decided to put our money into a strategy like this. 1955, Walt Disney had an idea for a theme park. Of course, he couldn't get a bank to bite off on the idea because it was crazy. It was something that had never been done before, totally creative, totally risky, might not result in anything. He couldn't get bank financing. So he took a significant amount of money in the form of a policy loan from his whole life insurance policy along with a few friends who were investors that believed in what he was doing. And that helped fund the startup of Disneyland. It was through a whole life insurance policy loan and then a few private investors that Walt had. Doris Christopher, 1980. You may not recognize her or her picture, but I bet you're going to recognize the company. 1980, she and her husband were brainstorming in Chicago. She decided to start a business out of her kitchen in Chicago. They didn't really have any money. They weren't doing that well for themselves, but her husband had a whole life insurance policy. They took out a little loan, a $3,000 loan, to start this little startup in their kitchen in Chicago. She grew it into a massive business, which she sold just a few years ago for several $1 billion to Berkshire Hathaway, and that company was the Pampered Chef. Here's another interesting example that's a little more timely in light of the election that just took place. Joe Biden, on his 2011 personal financial disclosure, you'll notice he has 6, I highlighted them, 6 whole life insurance policies he lists under the assets and income column. Assets and income, not an expense, asset and income. He's drawing tax-free income from 6 life insurance policies, whole life insurance policies. One other more modern day example, and I'm not saying anything here about sports affiliations. As a matter of fact, I'm not a fan of the University of Michigan. Sorry if you are. But Jim Harbaugh, the coach at the University of Michigan football, a significant piece of the deal he signed with the University of Michigan for his compensation is a significant form of that compensation is a life insurance policy that's being purchased on his behalf by the university to create tax-free income. And I won't get too far into the details of it, but this will show you how creative and flexible of an asset this can be. So Harbaugh receives his regular wages, whatever they pay him, and then he receives an additional $2 million a year in the form of a loan. The University of Michigan is loaning him the money to pay the premiums on this policy, which builds this tax-free cash account. And the loan comes due upon his death. Well, it's a life insurance policy. It has a death benefit, which is tax-free. So they're arranging a totally tax-free funding of a tax-free retirement account, which then the loan comes due upon his death, which will be paid out from a tax-free death benefit, and his family can sign the check over to the University of Michigan. They're made whole from all the money that they distributed to him, and he got to enjoy a tax-free retirement. So very, very creative arrangements. And by the way, it doesn't stop there. Big banks in the United States are the #1 purchaser of whole life insurance. They use it as part of their discretionary benefits for their most highly paid executives, doing exactly the same kinds of arrangements that I just shared with you about Harbaugh. So I give you all these instances or examples to say this isn't me that's telling you, hey, this is a good idea. These people are folks that are affluent, wealthy, or some of them. I mean, Doris Christopher and her husband weren't affluent and wealthy. They just happened to have one of these assets in place and were able to leverage it. If these folks are interested in this as an asset class, why shouldn't I be? Why shouldn't you be? Why isn't this worth looking at? And I think it is. And so I'll just share with you now, kind of bring it down to our level. Okay, we're not a big bank. We may not be Jim Harbaugh, Joe Biden, or any of these people. What's it look like on an everyday person level? Somebody who's investing in real estate, building wealth over time for their family. So let's take a look at a client case study just real quick. So I have a 40-year-old female real estate investor. We put this together for her a little over a year ago. And it's really important when we fund a plan like this, where this is going to be leveraged into the real estate investing or whatever you're doing. Maybe you're buying franchises or doing some other type of business. We have a source of capital already. So we're either warehousing capital in a savings or checking account. Maybe we've built up some funds elsewhere, or we're earmarking contributions every month towards our overall financial plan. So it's really important that we don't disrupt lifestyle income, that we go with what you're currently doing. So for this gal, what she was currently doing is she had some funds built up into a savings account that weren't really earning any real interest. And then on top of that, she's doing $2,000 a month. She's peeling off the top of her earnings and putting towards the future. And we said, okay, instead of those $2,000 a month going into, 401k and this and that, what if we peel off $2,000 a month and we put them into this vehicle with the plan that you're going to be doing the real estate investing anyway? And we're going to do that from now, age 40, until you're age 65. and just see what that builds for us as a capital account. And so here's what it builds. Just showing you 5-year intervals up to age 65. So by age 65, this gives her a tax-free bucket of money of $932,998. And all along the way, at each of those points you see, she's got access to that capital to use for the real estate deal she's going to do anyway. And so remember, the whole point is she's a real estate investor. She's going to build some assets. So what's that look like then? Well, let's just say in 5 years here at age 45, she leverages out $50,000 from that policy. So she'll take a policy loan for $50,000. And let's say that's a down payment on a single family deal. And then she's in the single family deal and either, exits with a sale, or maybe she does a refinance and is able to put the $50,000 back at that point. So maybe that's 6 months down the road, a year down the road, 3 years down the road. Doesn't really matter. You can pay it back however you see fit, put it back whenever you want. And you don't have to put it back. I would recommend you did. Again, we're cycling through this as a capital account, same as we would with business checking or business savings. And then let's say at age 50, she does another deal. This time it's $100,000. So of the 217 that's in there, we're going to leverage out $100,000 and put a down payment on a fourplex. And again, maybe it's the same deal. Maybe we refinance in a few years or sell it at a profit, or maybe we allow the cash flows from the property to put the $100,000 back. Either way, we put it back. Age 55, we do one more deal, $250,000. Maybe this is a syndication on an apartment complex, or maybe she's a general partner on that deal. And then again, over time, either through cash flows from the property or a refinance or a sale, we put the money back. And so whether we fund this thing at $2,000 a month over the 25-year period and we just let the money bake, or whether we leverage out $400,000 like I've just shown you with these 3 different transactions, either way, the net effect is the same. At age 65, she has $932,998 in there. So there's no opportunity cost for leveraging the dollars out. Think about what I just said, because one of the first questions I asked you when I started talking tonight was, what is the cost of interrupting compounding growth of capital? If you're keeping your cash in a brokerage account where you have to plug it into investments and take risk to get a gain, or let's just say you have a really high interest savings account earning you 3%, what's the cost for leveraging out the $400,000 or more, depending on how many deals you do and at what level you do them? There's going to be a cost. That number at age 65 is going to come down anytime you pull money out of the account and it stops earning interest. But a unique feature of a whole life insurance policy with the right kind of company is you can leverage out those $400,000 and it doesn't bring down your number at age 65, because you have the dollar still earning a dividend in the policy and you're putting the dollar to use in purchasing these assets that produce additional income. So it's a way to maximize the use of every dollar. Now, don't forget that along with the assets you purchased in this example here, where I show us getting the single family, the fourplex, the apartments, in addition to that, now at age 65, in addition, we've got this essentially acts like a Roth IRA tax-free account of $932,000. So let's take a look at the retirement income picture. And I see there's stuff coming into chat. So if some of those are questions, we'll get to those here in a second. Give me just a minute to finish up the example here and we'll take a look. So from a retirement income standpoint, first, let's take a look at the contributions that this real estate investor client made. From age 40 to 65, she contributed $600,000 to this account, to this policy. So that's what she put in. From age 71 to 90, if she just wanted to take a pension style tax-free income, she could take a little over $85,000 a year each year. Now, to do that, to get that same $85,783 a year in true income, if she pulled this from a 401k or a traditional IRA or 457, any account where she has to pay taxes on the money, if she's in the 24% tax bracket, she's taken out about $112,000 to get that same $85,000. But because this is tax-free, she can just pull $85,000 and it's good. And she has total tax-free income of a little over 1.6 million under the program I'm showing you. Now, here's the other thing. She pulled that money out in the form of policy loans. It was tax-free, never put back a dime. If she kicks the bucket at age 90, having taken all that income, there's still a remainder death benefit of a little over $915,000, which means her beneficiary is still going to receive a tax-free check as well. So when you look at money in versus money out, this is an account she contributed a little over, or no, $600,000 to. She was able to take 1.6 million in tax-free income and leave behind almost another million in tax-free legacy. So about 2.5 million comes out on the back end. That's what happens when we structure it properly. So before I go any further, Anthony, I've seen a bunch of stuff has gone into chat. Is
Sure.
there some questions sitting in there for us?
Yeah, some of them are mine, but we got a bunch of questions. So
Okay.
first one from John is, what is the interest rate you are loaning the money at?
Okay, good question. Real quick answer to that question. And then John, if you want further conversation offline, certainly happy to have a longer conversation. But the short answer is the rates I'm seeing with the insurance carriers we're working with now are between 4.4 and 5%. The dividends that those same companies are paying on that same dollar is anywhere from 4.7 to 5.5%. So you may be borrowing at 4.4%, but you're earning a dividend at 4.7. Or maybe you're borrowing at 5%, but you're earning a dividend at 5.5. So even when you leverage the dollars out, you're still seeing a little bit of arbitrage on the use of the dollars. That jumps into a longer conversation, which we don't have time for tonight, nor do I have the illustrations prepared for you, but I'm happy to have a longer conversation on that. Good question. Very good question.
Mine, mine was, are there transactional fees every time you take a draw, essentially?
Some companies do that. The ones I work with don't.
Okay. Another one of mine, are they usually interest-only loans or principal and interest? And typically, what's the repayment period and amortizations?
Yep. So there is no repayment period or amortizations. And as far as interest only or principal and interest, that's up to you. So let me kind of back the train up just a little bit, because I threw out the word loans and I didn't give you guys a lot of context. It is a policy loan in that the intention is you'll probably return the money to the policy. That's how we're able to make it tax-free. You don't necessarily have to do that, though, because this is an asset that you own. This is your money that you've put on deposit with the insurance company, and you're purchasing a life insurance contract. So you actually own this paper asset. So it's yours, you own it, you control it. Same as your savings account. When you put money in there, you own and control that. And if you have 100,000 in there and you decide to take out 50, you may or may not put it back. You're probably going to, because that's what you do when you're prudent with your money, is you keep building the cash account so you can do more things. I'm just giving you a different alternative for a cash account where there's no opportunity cost. And so it's truly up to you. You can leverage out dollars and not put them back in the account. And then all that means is your death benefit just gets smaller. Because what they're going to do is, let's just say you die and there's $1 million cash value and you've borrowed out 500,000 of it. Well, all they're going to do is whatever that 500,000 plus outstanding loan interest has accumulated, they're just going to pull that off the top of your death benefit, and whatever is remaining, they're going to pay your family or whoever your beneficiary is. So just as I've shown you in this example, this gal takes out policy loans of a little over 85,000 a year for a 19-year period or a 20-year period from age 71 to 90. She dies without having put any of that money back. And even so, the death benefit more than covers all of those outstanding policy loans and pays her beneficiary another $915,000. And it's because we structured it right. It's all in the structure and properly structuring the policy. Got some more questions? That was a great question too.
Yes, from Ed, the income earned through purchasing real estate assets from taking out a policy loan would still be taxed, right?
Yes. Yep. Because unfortunately, you can't put the real estate in a policy. So that would be the downside is, any money that comes out of the policy, once you plug it into another investment, you are going to see capital gains on that investment or ordinary income, depending on how it's taxed. Now, there's a little bit of an offset to that. Well, first off, with real estate, you have offsets immediately because of either cost segregation or whatever tax breaks you take on depreciation and improving the property. Additionally, though, I want to give you guys a thought, just thinking creatively about how you can kind of start to offset some of those other issues. Here's what I've done with my own. I accumulate cash in the policy. I've got a real estate deal I want to do. I personally own the policy. So that loan is going to be me personally getting a loan from the insurance company using my cash. Okay, let's just say it's $50,000. Doesn't matter what it is. I'm borrowing that at, let's say, 4.4% from the insurance company. I'm going to turn around and mark that up to 6 or 8% and do a private loan from me to my LLC and charge my LLC 6 or 8% so that I am essentially acting like a banker and collecting a spread on my borrowing rate versus my loaning rate. And now I've given my LLC a tax deductible interest expense, which will then come back into my pocket as income. So that's one creative way where you can maybe begin to offset some of the tax impact. It won't completely take care of it, but it's a good offset.
And is the policy interest, is that tax deductible as well, at 4.4%?
Not what I'm personally paying the policy. No, it won't be. But what my LLC pays to me will be.
Got it. And this is probably intuitive, but if there are taxes on the real estate assets, I'm assuming like you can use that income freely. There's no restrictions against it, whatever you receive.
Absolutely. Absolutely.
Great.
Again,
Thank you.
Yep, absolutely. Great questions. And again, guys, you own and control this asset. So as soon as you decide you want to leverage cash out, you can do it for whatever you want. I think the smartest use of it is to buy income producing assets, but that's not to say that you couldn't buy a really nice car with it. As a matter of fact, we have an advisor in my office who just bought her first Maserati, and she paid cash with it from a policy loan because she thought, instead of go get bank money and build wealth for the bank while I pay off my Maserati, why don't I borrow it from myself and make deposits to my tax-free retirement account as I make my car payment? So, I mean, there's a lot of different ways that you can use the money. It's totally up to you. Any other questions before I just move on?
Good to go, Adam.
Okay. So just kind of bringing this home and wrapping this up, guys, because I've shared the primary concepts I wanted to share with you tonight. I thought, well, what if we did just take a look at this strategy I just showed you versus a high interest savings account? What does the difference look like? What does some of the opportunity costs look like? And when I went online, this was a couple months ago, I went online to try to find the highest interest rate savings account. So maybe you guys can find something higher, but this was the best I could find. Is I found one, I think it was Bio Bank, but I don't remember for sure. Hadn't never heard of the bank, but it looked legit. And they were offering 1.6%. And so I said, okay, we'll go with that. Let's say we can get 1.6% on the same 600,000 over the same 25-year period. By age 65, if she just puts that money in and lets it bake at a compounding 1.6%, she'd have $782,000. If she turns that into retirement income, she's going to run out of money by age 79, and she's only going to have realized $665,000 in income. And the reason for that is because she doesn't have the policy as tax-free money. She's pulling from 401ks, traditional IRAs. She's going to be in a tax bracket such that she's going to need some of this money to offset the taxes she's having to pay on the money coming out of the traditional retirement accounts that's being taxed, which will never come to her pocket. She's just going to have to say goodbye to that money. She's going to have to offset that with some of this account. And so for that reason, she doesn't even get to realize the full $782,000. She only realizes $665,000. Now, I already showed you the example where we use the policy. She has a little bit more than that. She has $932,000 at age 65, and it turns into $1.6 million in income. How is that possible? Think about that. Because if you're good at math, you're thinking, wait, this doesn't look right. On the one hand, he's showing me an account that starts with $782,000, but I can only use $665,000. I explained the reason for that. We're going to have to offset taxes we're paying on our retirement withdrawals because, by the way, those aren't optional. If you have a 401k or a traditional IRA, you're required starting at age 72 to take money out, and the IRS doesn't let you choose. They tell you how much you're taking out, and they make you pay taxes on it. And if you tell them that they can stick it, they're going to stick you with a 50% penalty, 50% of the amount you were required to take out. So it's no bueno not to play by the rules. I'm just letting you guys know, like traditional retirement accounts, when you get to age 72, you're paying taxes, no choices, you're paying them. So, all right, so going on to the cash value life insurance scenario, we don't have to pay taxes on any of that money as it comes out. And remember what I told you, even when you're taking out loans and leveraging dollars, you still get the full dividend out of the policy that year. And each progressive year, each succeeding year that comes one after the other, the dividends get higher because the cash value contractually has to go up. You're contractually guaranteed upside. And so what that means is you can start with a bucket of $932,000 and you can get more out of it than what's really there, because over that 20-year retirement period, you're still accumulating. Even though you're pulling money out, you're still accumulating to the upside. And so you're able to take out 1.6 million. So let's take a look at what's the opportunity cost. What does it cost us when we interrupt compounding growth? And what does it cost us when we're not insulated from rising tax rates? Which, by the way, I just made the assumption of a 24% tax rate. I didn't raise it at all. I just assumed 24% tax rate. So if tax rates go up by 10% or double, these numbers get worse. The compound interest she loses out by leveraging out the money I showed you guys in the example. If she uses the savings account and she interrupts compounding, she loses out on a little over 122 grand. She pays a little over 28,000 in taxes while she's accumulating, because each and every year you have to pay taxes on the gains. And that 28 shaves off the whatever your compounding would be, because you would have kept it in the policy. And then when we look at a retirement income scenario, again, we ran out at age 79, and we were only able to take out about 964,000 less from that savings account because we weren't able to keep compounding growth like we can in the policy. So all told, we're using the same $600,000 over the same time period, doing the exact same things to it, but it's the vehicle that matters. And just by changing vehicles, you can either end up with $1.1 million more or $1.1 million less. So I think that's probably the most revealing piece when it comes to thinking about your strategy from a capital standpoint, that maybe makes this worth looking at and exploring of, hey, does this make sense for me? And this was the kind of thing that I did, kind of scenarios I ran back in 2011 when I was introduced to this concept, because I was skeptical as hell, guys. And you should be, because it looks and sounds too good to be true. Totally understand that. So I was skeptical and I dove into it, researched it, looked at the numbers, and it's pretty revealing what the opportunity cost is when you interrupt compounding growth and when you have to pay taxes on the money. So last question in closing, and then I'll quit the screen share. We'll get to the chat and finish up our conversation. What could you be building just with a change in strategy, doing all the same stuff you're doing right now? Is there a way to enhance what you're already going to do? Is there a way to do it better? And so we covered how you can insulate your capital from market risk and rising tax rates. I showed you what it looks like if we enjoy uninterrupted growth of capital. And I showed you how we can accelerate that process of creating wealth by growing assets in two places at the same time, using both the capital account through the policy and whatever investments you're leveraging into. So, questions just to ask yourself: am I currently insulated from market risk and rising tax rates as far as where I'm keeping my cash? What could I accomplish if my cash was in an account that has uninterrupted compounding upside growth, no downside risk? And does my current capital strategy allow me to earn on dollars in two places at the same time? Guys, I want to put up my contact info just real quick before I end the screen share. So that's my personal number there. That's the best way to reach me by phone. If you want to research the firm I'm with, Prevail Innovative Wealth Strategies, that's our website, prevailiws.com. There's my email. And then what I'll do here is as soon as I stop the screen share, I'll drop this into chat for you. I'm going to go ahead and stop the share, guys. And let me drop my LinkedIn in the chat for you if you want to connect on LinkedIn. And then let's get to the rest of the questions. How are we doing on time, Anthony?
10 more minutes.
Okay. Is this good stuff, guys? Is everybody liking this? Is this helpful?
Yeah, I think this stuff is great. I think, as you said, I have to do a little bit more research, because like my first initial impression is that it is a little too good to be true, maybe from the the dividend that you're getting from the insurance company and the arbitrage spread there. But one of my questions for you, Adam, but this is great stuff. One of my questions though is, what, what books or resources or other kind of research would you recommend kind of pointing us to learn more?
Yep. Great question. One of those books, by the way, I have on hand as a PDF, and I'm happy to just give you guys, but there's 3 books I'd tell you that are really good. They're all good. But the first one I would probably recommend to you as it relates to real estate is there's a book called What Would the Rockefellers Do by Garrett Gunderson. I have that in PDF format, and I'm happy to share that with anybody that wants to connect, and just give me your email and I'll send it over to you. You can read it. It was the book that really kind of pushed me over the fence to where I'm like, man, I need to do this for me and my family. There's another great book called Live Your Life Insurance by Kim Butler. You can just Google that, or on Amazon. I'm sure you'll be able to find it. As a matter of fact, I think it's at prosperityeconomics.org. Prosperityeconomics.org. You can go there. That's Kim's site. She'll let you have the book for free. You just got to pay shipping. I think it comes out to $5 or $6. And then the last book I would tell you guys, and it actually goes to the beginning of my presentation where I showed you the different tax categories: taxable, tax-deferred, tax-free. There's a really good book on planning tax-free retirement income, using this as a piece of your strategy. And the book's called The Power of Zero by David McKnight. And a lot of the education our firm does, we use a lot of the same teaching tools and principles that David does, and are very much in alignment with his message that we just really believe tax rates are likely to rise in the future. And most of America is just not in position for it. Most of America is in a position where if we saw a 10% tax hike, which isn't even that big, guys, tax rates have been 94% in the past. In 1944 and 1945, after World War II, the highest marginal tax bracket in America was 94%. And our highest tax bracket right now is 37. And we've been doing more government spending than we've ever seen in history. So I feel like it's a pretty strong argument that tax rates are likely to rise. But those are the 3 books I'd recommend. And I'm happy to, again, if you want to connect over LinkedIn or whatnot, happy to give those to you again.
Sounds good, Adam. Thank you.
You bet. Prosperityeconomics.org, Dwayne.org, O-R-G. You bet. Any other questions you can see in there, Anthony, that I might have passed over? I don't want to miss anybody.
I don't think so. I think maybe we'll do a follow-up one at some point, Adam, if you don't mind. And
Absolutely.
as Ed brought up, the arbitrage between the insurance company and the dividends you receive, I think that'll be an interesting topic. And that's that's probably a whole session, right?
So I will share just a little bit more, because I can tell there's some folks on here that are interested in doing a little of their own research. I would just caution you guys, and I think this goes without saying, but I want to say it because I think it's important. This is something my family and I do with my own money. Been doing this since 2011. The people I work with in my office, we do this with our own money. So we intricately understand the details of how to build these policies properly, how to use them, what it looks like, and how it works. There are a lot, I think, of advisors and life insurance people out there that profess to be able to implement this strategy and teach it. And I would just caution you that if they're not doing it with their own money and not personally experienced with it, I'd be leery. The other thing is, there are only a small handful of companies in America, mutual insurance companies, not publicly traded stock companies, mutual life insurance companies, that offer the right types of policies that pay a dividend even when there's outstanding loans on the policy. And so you want to make sure that you're working with a company that's called non-direct recognition of loan. That's the insurance talk, which basically means when you have a loan outstanding, they don't directly recognize that outstanding loan and they pay you the full dividend. Most mutual life insurance companies are going to be direct recognition, which means if you have a policy loan outstanding, they directly recognize the loan and they discount your dividend. That's not what you want. You want non-direct recognition. So that's one key piece. And then the other thing is just an advisor that truly understands what they're doing. So hopefully that's helpful insight to you guys as well.
One last question from Sunny. Can I change my traditional insurance to cash value?
Possibly. It's going to depend on the company and everything that I just mentioned to you about, if you have, and I'm not picking on State Farm. They're one example of a company that doesn't have this product available, and a lot of folks use them. So if you have a State Farm term policy, you're not going to be able to convert that into anything like what I showed you. And so again, not picking on State Farm. He says, I have John Hancock. Okay. So great provider for a term policy, right? Probably very affordable. But they're not going to have the product to achieve the kind of asset building that I just showed you. They're not going to have, I mean, they just can't. It's just not built for that. So the answer, Sonny, would be you need to look outside of that for options. You need to look at different companies. Yep. And happy to walk you through that. Or if you have a trusted person that works with you on this and understands this strategy, then consult them.
Okay, I think we're good here. Anybody have any other questions before we wrap up?
Thanks a lot, guys. This is really good. I feel like everybody's asked really, really good questions. I feel like there's been some great engagement and participation, and that always makes it fun. So thank you.